Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
And we are back, episode 134, Carson's Facts versus Feelings. Ryan and Sonu. Sonu, this one we're going to title it Slowing, Not Cracking. Talk about the economy a little bit. But Uncle Warren, after I think a 5-hour Q&A, right at the end, like any good showman, left them wanting more, dropped some big news that he indeed is going to step down from CEO. I believe he's staying on as chairman of the board. Greg Abel's going to take over. This is not a shock, I don't think. I know the stock's down initially Monday morning, time we're recording this. But what are your thoughts on Uncle Warren? Just take this anywhere you want. Things you've learned, whatever you want to say.
Actually, first thing is, I wonder what he's going to do tomorrow that he wasn't doing 3 days ago or even 10 years ago. I like how involved or not involved was he with the business, with Jane and Abel and all these guys coming in, right? Like, I don't just see him walking away into the sunset and doing nothing, right? No. Maybe take an extra McDonald's trip and have an extra cherry Coke. No, I imagine he's going to be as involved or not as has been the case for the last several years. And with respect to like, we've written so much about him. I mean, maybe I'll link it in the show notes or something. But one thing is, you always see finance people, especially in the industry, like, hey, take advantage of compounding. Take advantage of compounding, right? But then when it comes to things like income, I want income from my portfolio, I want dividends. Warren likes companies who pay out dividends, but he never paid out a dividend.
Yeah.
I think Meb Faber was on a podcast. One time he paid out a dividend. He said he was in the bathroom or something and the board agreed to a dividend, right? Like decades ago. And he was like, what are you doing? No, dividends take away, because the moment a dividend is issued, you have to pay taxes on it. And that's money that you've shipped off to the federal government is not available for compounding. So I think people show all these charts about like, oh, look, see, your money compounds. That should be the first thing is teach our kids. But nobody internalizes it. They're like, no, I want dividends. I want more dividends. Well, you're losing out on compounding, right? Take it out of capital gains later when you need the money. I think that's taxes and compounding is a big lesson. I think I've learned from Buffett because I was always curious, like, wait a minute, why doesn't he want to pay out dividends? And that makes complete sense. The other thing is leverage. Yeah. Right. He uses leverage. He uses a ton of leverage. So I don't think, like, people talk about, Warren's cash pile is so high. That's kind of meaningless, right? That's the money that he gets from his insurance premiums from Geico. And like, I get my auto insurance through Geico. I'm sending Uncle Warren a premium every month. And that's the cash, right? Like, so, and he uses a ton of leverage, including for some amazing Japanese companies he's bought. So, I mean, he's the greatest investor of all time for more reasons than just he picks good stocks.
Well said. Morgan Housel shared some stats. I guess it would have been on Saturday when a lot of this news was coming out. If you look at his company, Berkshire Hathaway, from 1965 to the end of 2024, last year, that stock is up. This is according to Morgan. I'm sure he's right though. 5,502,284% versus the S&P 500 on a total return basis, the same period, 39,054%. And it's not like every year was by a lot, but that again is the power of a couple percent a year over 60 years. One more from Morgan. This one's just mind blowing, but I guess it's true. If the stock was to fall 99%, he'd still outperform over his career. I mean,
I guess his career is over, and so that's done.
Oh my goodness, just unbelievable. Anyway, so yeah, we're huge fans. Obviously, Carson Group is based in Omaha. Warren is clearly, just the man, I guess, for lack of a better phrase, in Omaha and in our industry. So congratulations, well deserved, and we'll just kind of leave it there with Mr. Warren Buffett.
Yep.
All right.
What's up?
So first things first, what do you want to talk about? I mean,
There's
I
a
guess
lot
markets,
going on.
there is a
we
lot.
Have
There's
more
a lot.
tariffs. We have tariffs on movies now, and like
I don't know.
I
Yeah.
don't know where that's going, but
Who knows?
we have
By the time
tariffs
people
on
listen.
movies. We have tariffs on small goods, coming into the country. We have, by the way, nobody's talked about this. The auto sector tariffs slowly and silently went into effect on May 2nd. So that's in place now too. So,
Well, I'm going to talk about things we know. How about let's go that route? Let's start with markets, what we know. On April 30th, so last week, the S&P 500 recovered more than half of the near bear market. Now, Josh, I do have this chart. I sent it to you so we can put this on the YouTube channel. There have been 16 times the S&P 500's had a bear or near bear market, like we just saw, obviously, just a few weeks ago. Sonu, once you recover half of that bear or near bear market, only once in history has the stock market rolled over to make new lows. Now, just to make this more fun, that was in 2022. We were talking about it. It's never rolled over to new lows. Right. Well, we barely cracked new lows in October 2022, as we all remember, down 25%. It was off to the races ever since. But if you simply were to buy the S&P 500 or start the clock on the S&P 500 on the day you recover half of the bear market, 1 year later, ready for this, higher 16 out of 16 times, up almost 8% on average. 6 months later, you're talking 10% on average, 10% median, higher about 7 out of 10 times. Just pretty strong returns. This is just one data piece. If you remember last week, I really dug into this wide breadth thrust and 3 days in a row of over 100%, 3 days in a row of 70% of stocks up. Just wildly bullish across the board, looking purely at technicals of the market. This is another potential positive. One more, Sonu, and I'll bring you in. The S&P 500's advanced decline line was always hanging in there quite well. The S&P was down, believe me, we get it, like virtually a bear market. But the advanced decline line was not breaking to new lows below the lows of the fourth quarter last year.
Advanced decline line is how many stocks are going up versus how many going down, right?
That's what I was just going to say. Advanced decline line is how many stocks going up every day on a cumulative, or up versus down on a cumulative basis. Keep this real simple. When that makes a new high, that tells you something. It tells you there's some strength under the surface. Maybe the market, which is up, down about 3% on the year approximately for the S&P, although 8 sectors out of 11 are higher on the year. There's some strength there, and our friends over at Bespoke took a look at this. When you make a new high on the S&P 500's advanced decline line, with the S&P more than 5% away from all-time high, so a decent amount away, not that far away, but decent amount, like we just saw. They found like 6 times within 6 months. You're making new highs most of the time. So does breadth lead price? I grew up saying it does. There's other things to follow, but the market breadth on the ADE line on the S&P 500 making new highs is a pretty decent sign that we might see new highs on the S&P 500, which, all things considered, aren't all that far away where we're sitting. You want to talk about earnings, maybe? Earnings have been very impressive. Another reason I think we've had this rally. What have you seen so far there?
Everything was it was Q1, so things are going, I guess, well at Q1. Right. I think the damage has been in tech and consumer discretionary. Consumer discretionary mostly, again, not a recommendation, right? It's mostly Amazon and Tesla. This stuff coming into this year was, we've talked about it before, that when expectations are high, it's harder to meet them. I think that's been the story. And despite what's amazing is over the last month, tech was positive. I think tech was positive in April, right? The NASDAQ was
NASDAQ was 100.
Yeah.
Yeah, both of them were. Yeah.
And what's interesting, especially we'll talk about the economy and slowing, and as opposed to like falling off a cliff. People expected, oh my God, we got the tariffs, we got Liberation Day, things are going to fall off a cliff. That should never have been the expectation, right? And it's not like companies didn't know tariffs were coming. They did through Q1, and which is why the earnings reports that we've gotten have been, okay. They've been pretty good, right? Yeah. Because things haven't fallen off a cliff, especially outside the outside the U.S. Things certainly haven't fallen off a cliff, right?
Right.
And I was looking at, look, the Mag 7 has been hurt a lot. Like if there's an ETF that tracks the Mag 7, that's down from all-time highs about 18%. You look at the Dow Jones Transportation Average, that's down about 21% from all-time highs. The Home Builders ETF, you think, we talked about the Fed and how rates are probably too high. We'll spend more time talking about it.
Yep.
The home builders ETF, that's down about 22%. So there's damage in certain pockets of the economy, but a recession is not damage to certain pockets. It's widespread damage. And then you look at what's the first thing you would normally look at, if there's real damage to the economy. You think it's a financial sector, you think it's a banking sector, but financials have been holding on. Financials are down less than 5% from all-time highs.
Wow.
That's not bad. That's not bad at all.
No.
Right? The S&P 500 is down about 7.5%, but that's, it's got a lot of tech and things like that, right? Tech is down about 11%. But yeah, look at financials. And that tells you that we're not on the verge, or market's not pricing in any sort of, financial crisis, right? That's a positive. That's a big positive, I think. I mean, amongst other things. And with respect to the economy, we'll talk about it, like seeing is believing, right? First, let's look at it.
I'll chime in a little more there. Big fan of Barron's. Been reading it for many, many years. Come in this weekend, and Barron's has a "Where did all the bulls go?" with a lonely little bull on the cover. And the Barron's Big Money poll came out. It's it's twice a year, every 6 months, usually October and April. And Sonu, that's what they're talking about. Where did all the bulls go? There were 50% bulls this time 6 months ago, and it dropped substantially. Now we have the lowest number of bulls they've ever seen in this poll, going back to 1997, highest number of bears since 1997. And they asked the big money managers, what do your clients think? Okay. This is according to them, though, only 7% of their clients were bullish. Now, I don't have the historical data on that, but that's pretty over the top. Now, let's be clear. They might have done this a couple weeks ago before the 9-day win streak. And the time we're recording this Monday morning, yes, there's a 9-day win streak. We'll see if we get to 10. So price can change people's opinion. But that's one of the things we've talked on this very podcast a lot about. I've been talking a lot about just we're seeing historic amounts of negativity. I've done this for 26 years. There are a lot of smart people that are really, really worried about what's going on out there. And, from that contrarian point of view, you get any good news. And we have earnings up over 13% the first quarter year over year. The time we're doing this, March 31st, expected to be like 7 or 8%. So that's 5% better on earnings. And yes, it's the quarter that just happened. And yes, guidance is murky at best, but still, the worst we were being promised, a few weeks ago, might have missed the asteroid one more time. What else you want to add on markets here?
It's about surprises, right? Like that same poll, I bet if they took it 3.5 months ago, maybe 4 months ago, there probably would have been a lot of polls. Right?
On February 19th, which was the last all-time high, by the way, there was a lot of bulls then.
You had a lot of bulls. And then suddenly things surprised to the downside. And then we got Liberation Day. Even before we got Liberation Day, things are surprising to the downside. I think there was a slowdown that people maybe we're not going to get 3% GDP growth. Maybe it'll be closer to 2%. And so there was a re-rating. You and I talked about this. I think one of the episodes we did is growth scare, right? That was before Liberation Day. It wasn't after. And then after Liberation Day, sentiment just plunged all the way, to the bottom. And then we got an upside surprise. Tariffs are not going to be that bad. I think, it's about surprises. And the question is, what's not priced in now, and where is the next surprise going to come in?
Well, speaking of surprises, let's take a U-turn for a second. One of us on this podcast turned older last weekend.
Not a surprise.
He's much older than the other guy by 5 months. 5 months. Same year, 5 months. You had a birthday, so happy birthday to Sonu. Any surprises? Did you do anything fun on the weekend? What happened up in the Windy City for your I don't know 23rd or 24th birthday, whatever it is?
Yeah. So 47. That's
okay. Good. Because I always forget how old I am. I'm going to ask you, and then it's like half the year we're the same, and half the year we're not. But I'm always younger. I'm always younger than you, old man.
For 5 months you'll be like, oh, I just subtract 1 from Sonu's age, right?
He's just old. I'm just calling you the old guy. You're the old guy. You're older than me. You're the old guy.
I know. Yeah. But maybe age before beauty. So no, I think the surprise is it probably ought not to be a surprise that how long it takes for you to recover the morning after, all I'll say is I had a nice night on Saturday night. Sunday was a birthday. That it took half of Sunday to recover. But I did catch, I was at the buddy of mine and my wife baked a cake, chocolate cake. It's always chocolate, as you know.
Oh, yeah.
So we had we had a nice dinner and, cake and all that. And then I went out, caught some jazz actually, out downtown. So that was nice. an hour and a half of jazz. So it was good. It was a good
good.
birthday. Very, I wouldn't say mellow because the previous one was not mellow. But it's just a reminder that, just take things easy as you get older. Like Uncle Warren.
Yes. Then we forget. A couple months go by and you have fun.
Oh, totally.
That's how it goes. I was going to say something else. I want to talk about Sell May Go Away. Oh, here's what we're going to bring up.
Oh, yeah.
So we'll do Sell May Go Away, then we'll go forward. So I'm showing on the YouTube channel. This is Prime. Okay, it's an empty bottle of Prime. I don't think a very tasty drink. My boys like it. It's popular, I think, with Jake Paul and YouTube. Long story short,
is that an energy drink? What is that?
Yeah. I mean, well, let's see.
Is it like a Red Bull or something, or is it like one of those vitamin?
Well, here's what it says. It says hydration drink is what it says.
Oh, okay.
This is Cherry Freeze. I'm holding this one for a reason because last night my dog Mabel, our 110-pound Great Dane, just started going crazy in the house barking. And we're like, Mabel, what are you doing? I mean, I'm talking like going rabid. And I go in the kitchen and this is sitting on the table and she's just going crazy at this.
Wow.
This is the actual bottle. Like I'm holding it. This will be funny on the podcast.
God.
She was going nuts barking at this red bottle of Prime. I go, what do you do? I pick it up and I kind of walk towards her to show her the bottle. Sonu, she like started growling, snarling. She ran off. I have no idea. I'm like, one of my boys must like hit her with one of these or something. I don't know. I mean, she's not a big fan. She's a Gatorade fan apparently. I don't know.
Okay,
but I don't know. It was funny, and everyone has a different reaction to things. But I thought that was a wild one. The way the dog was not a fan.
Prime makes keep the Prime away from the dogs.
I guess so. I don't know. So anyway, let's see here. So Sell in May Go Away. You've probably heard about this. I wrote a blog on it last week, carsongroup.com/research. These next 6 months indeed are, and Josh, we can put this chart up. Actually, I've got two charts I'm sharing with you on this, but the first one with all the different colors is one we want to share. These next 6 months indeed are the worst on average. Now, still up 1.8% on the S&P 500. Now, we just left the best 6 months. I know you got some thoughts on that, Sonu, so save that for a second. It sure didn't feel like the best 6 months. So it's something to think of, but there's something for everybody. The month of May has been higher 9 of the last 10 years, and these worst 6 months have been higher 8 of the last 10. We gained 13%, Sonu, last year in these worst 6 months. So we pay attention to it. We're aware of it. We don't blindly invest in Sell in May Go Away. And all the buying thrusts and some of the things I pointed out, over the last couple of weeks, I think the Sell in May Go Away period will probably gain a little more than 1.8%. Might be a decent one for investors. I would not advise selling in May going away this year, but we are aware it's popular. It's out there, and a lot of people have been talking about it as, again, it is what it is. Now, Sonu, we just had a bad best 6 months. What? I don't know. What in the world's going on?
I think that's where the damage has been, right? Like the same chart. I mean, Josh, if you keep that on there, you'd see November through April, best 6 month period historically, and you have an average percentage change of 7%. Yes, average is almost never happens, but it's better than everything else on average, right? And what we saw the last 6 months, the S&P 500 is flat.
Yeah.
Right. So which is not bad considering everything that's happened. We'll take it. We got a big rally. It could be worse, right? But the opportunity cost is where the damage has been, because this is a seasonally strong period. There's the first 100 days of a new president, even though, maybe it's a second term president, but still,
right.
First 100 days. And you would expect things should be going, as well as they could, right? Because all the, where rubber hits the road is usually the next 6 months or the midterm year. We haven't talked about midterm years, but that's a whole other thing, a whole other beast to deal with. But yeah, this should have been positive and it wasn't, which tells you how much policy has taken things off the rails. And it really did, right? That's what it tells me. And despite that, at the end of the day, it's still flat last 6 months. That's not bad.
Yeah. Hey,
right?
Yeah. Well said there. We gained 20% 2 years in a row, more than 20% 2 years in a row, and we are down 3% on the S&P right now. I mean, we get all the headlines and the worries. We're not minimizing any of that, but from a purely investment point of view, I don't think that's all that bad. I mean, call me crazy. And again, the rest of the globe is really doing well. We've talked before about developed international and the money that we run for our Carson partners and their clients. We've been dipping our toe into developed international, specifically Europe. Again, Europe's been doing very well, right? Diversify. Oh, what does Grant say? When in doubt, diversify it out.
Right,
Grant on our team said that, and there is a lot of doubt out there. And listen, yes, I personally think the lows of the year are in, but that doesn't mean we're going to go straight up. I mean, we're like right on the cusp of the 200-day moving average, where 87% of stocks are above the 20-day moving average. I mean, we've got a very, very overbought near-term market, Sonu. And some of these bullish stats I've talked about before, 1 and 3 months out, you can get some indigestion. You can get some choppiness.
Sure.
It'd be perfectly fine. So, yeah, the lows might be in. That doesn't mean you just go all in here. Maybe you wait for things to come back to you a little bit. But you look around Europe and other parts of the globe doing well. Now, I'm going to complain for a second here. I was supposed to be on CNBC this afternoon. I just got the email. Sorry, Ryan, going to move you to Thursday. I can't do Thursday because I'm traveling, so I got to figure that out. First world problems. They said because I was on CBC Friday. I think they were saying the two were too close to each other. But
did they take the markets up, and so we don't need Ryan Detrick anymore?
I don't know. I guess so. I don't know. I was all excited. I was on CBC this afternoon, but honestly, that's kind of nice.
I know you and I have a meeting later.
Oh God, dude, we've got meetings. I've got a haircut. You and I both fly out. I'm going to the great state of Texas, going down to Austin tomorrow. Cannot wait to go down there and hang out. So this is a joke
for me. Oh my God, for me, like maybe.
Hey, go to that McDonald's. Go say hi to somebody. Yeah. What was I going to say? Now I've got a little more time this afternoon. I was more worried about the TV thing. I don't have to worry about it. Oh, people are always like, when you go on TV, do you get nervous? Are you worked up? No, I've done it so many times. The answer is no. I get excited. I enjoy doing that stuff. But they say, do you know what they're going to ask you? And I send a bunch of notes. And trust me, when you're on with like Judge on CNBC, like I was supposed to be, and maybe I'll be on.
This is Scott
Wapner. I mean, he's not going to ask you what you sent him. I mean, it's going to be whatever he wants. But here's my joke I say. They say, do you know what they're going to ask you? I say, nope. But I know what I'm going to tell them. That's what I've always lived by.
You've told me that as well.
I think I've told you. I said always have one or two little stats in your head, and no matter what and it's almost a challenge to yourself. They can ask, "What do you think about Greek debt?" And I answer about the advanced decline on the S&P 500. It's almost a challenge to tell them what I want to say, not what they want to hear. All right, that. So anyway, so sell them may go away. We got that wrapped up. I will say also my fridge. Remember a couple weeks ago I talked about my fridge. We moved on. I think it was with Kathy. We were on the Kathy Wood 2 weeks ago. My ice machine wasn't working. My wife was MacGyver, if you will. She got in there, and there was some ice stuck way deep in the ice machine. So we have ice in the Detrick household, but it gets better. The other day, I looked up. We looked in the ceiling, and we saw like a watermark. We're like, "Oh, that doesn't look good. That doesn't look good at all." Directly above that is our shower in our bathroom. So now apparently our shower is leaking. We're trying to figure out why it is. Now I'm using the kids' bathroom. I had to take a shower a little bit ago. Of course, my daughter was home for some reason. She's supposed to be in school. What do you?
And you never want to use the kids' bathroom.
No, right? I don't want to use it at all. So now we're all 5 of us share one bathroom. So thankfully, I'm going to Texas for a couple days. I might just stay about another week. I love Texas. Get my own shower, get my own barbecue. But anyway, first world problems there.
Ice and a first world part of the world that does not have ice, a lot of ice in Europe.
You're going to get us back on task here?
Yeah, all over the place. No, you were talking about international returns. So the MSCI EFA index, the developed markets, you said the S&P 500 is down about 3% year to date, thereabouts. We're doing this on May 5th, Cinco de Mayo.
Oh, yeah. Happy Cinco de Mayo, everybody.
Yes, there's that too. Yeah. And the MSCI EFA index for developed markets, it's up almost 14% year to date, right? The EM index, emerging markets, if the rest of the world's economy was really falling off a cliff, I don't think EM would be doing as well as it has. Exactly. It's up 6% year to date, right? But I think therein lies the story. I think the biggest story actually has been, or one of the biggest stories, tariffs, obviously the biggest story, but a downstream impact of that is really the dollar, right? We've seen, almost a V-shaped recovery since, let's just say it is a V-shaped recovery since Liberation Day, not since the all-time highs of February 19th for the S&P 500, but since Liberation Day, we've more than gained back, everything that was lost, but the dollar is still down. The dollar is down about 4.5% to 4.6%, maybe 5% after today's move. It's down about 8% year to date. So the dollar is not recovered. And I think that's still an ongoing story. It'll be interesting to see where it shakes out. But a weaker dollar is a tailwind for international equities, especially if you're not hedging for currency and stuff like that. And you're seeing that in the returns.
Is there a baby? What is that noise? Is there a baby crying?
Yes, there. You know what?
Is that your house? What's going on, Sonu?
So my sister's visiting.
Oh, your sister's visiting.
Yes.
Okay, never mind. No.
Yes.
Well, so your nephew is saying hi. Your nephew.
Yeah.
I think he disagrees. He disagrees with whatever you just said.
He's probably like buy US, don't buy India or something.
Exactly. That's funny. I was teasing about the baby, but there is a baby in your house.
There is a baby. I forgot. A 15-month-old. So
how long are they staying? They're hanging out for a while.
She's here for 3 months. Yeah.
3 months.
3 months.
3 months.
Yes, 3 months. Yes.
You have a baby in your house for 3 months.
3 months.
How's that treating you?
Well,
It's probably pretty fun, I guess.
It's fun, especially because this is a baby whose diapers I don't have to change often enough. So, I get the good parts, right?
Okay. That's I didn't realize she was staying that long.
Yeah, she's staying for a while. Yeah.
How long has she been here? Are you at the halfway point, or
no? She's just been here for 20 days.
Okay.
Barely.
Yeah,
no, not even. About 2 weeks thereabouts.
Okay, that's neat.
It's a long way to go. Long way to go. Yeah.
We'll see. Yeah. Well.
No, it's good having her.
That's good.
We get along well for some.
Well, good. Well, you're going to find out.
Yeah.
I've been to your house. You got a great house, but in Chicago, they're all a little smaller. Not a ton of room to go off and hide, like a big house in the Midwest.
Right?
Yeah. Oh, yeah. Which is fine. But yeah, you're going to find out if you like each other in another 40 days. All right. Let's try and wrap this thing up about 14, 15 minutes. So let's talk about that economy, right? We titled this one episode 134, Carson's Facts versus Feelings, Slowing, Not Cracking. And I would like to remind everyone, if you want to hear the latest from us, don't forget to subscribe to our podcast. You can leave a review. We love your feedback. And then Facts versus Feelings, VS at carsongroup.com is our email. Please let us know or ask any questions or any comments at that email. We're checking it. All right. So again, slowing, not cracking. I mean, we could talk about GDP. We could talk about jobs. Where do you want to go with this?
Let's do GDP, since that was, looked like, there's things are falling off a cliff here.
Right.
But, that was a really noisy, messy, muddy GDP report. Right.
I'm going to assume you're going to send Josh a chart, and we'll just say, Josh, put the GDP chart up right now, whatever Sonu sends you. Yeah.
Yes. And so real GDP growth for Q1 clocked in about negative 0.3%. Mm-hmm. That was, near estimates. But why this is notable, this is the first negative reading for real GDP growth in 3 years.
Yep.
Since the first quarter of 2022, over the last 2 years, 2023, 2024, real GDP was going at about 2.9% annualized pace, so close to 3%. So this is a big slowdown just on the surface of it, right? But what happened? We got a big drag from net exports. What's net exports? It's exports minus imports. It pulled GDP lower by 4.8 percentage points, or in our parlance, 480 basis points, right? Yeah. And that's because imports surged by 51% in the first quarter. Wow. 51%. Wow. That's because households and businesses were front-running tariffs. As we said, this was all before Liberation Day. We knew this tariff thing was going to happen, and people are front-running the stuff. Now, I think we have to be careful here. I see a lot of people like, imports subtracted from GDP, so it doesn't count.
Right.
Look, GDP is gross domestic product, even though this GDP number, as Goldman put it, is like gross distorted product. But look, it's domestic production, right? And imports don't count towards domestic production. And there's no easy way to measure production. I mean, we do it to value add, things like that. There are other ways to measure economic growth, but those are much more delayed numbers. So what the BEA, the Bureau of Economic Analysis, does is measure sales. Right? How much are consumers spending? How much are businesses spending and investments? How much is the government spending? And they then take out imports because imports don't count towards GDP, domestic product, right? And so that's why, it looks like imports are subtracting, but it just to avoid double counting, to not count. Like consumers bought a lot of footwear, clothing, things like that. Business bought a lot of IT equipment last quarter. That was all imported. So it shouldn't count towards domestic product, right? Now, where it gets confusing, and I've done this for the last 2.5 years, the best way to look at, how strong is the underlying economy?
Right.
Take out the volatile piece of GDP, which is inventories and net exports. Then you're left with household spending, business investment, and government spending.
Okay.
Last 3 years, 2023 and 2024, final demand, right, from all these three sectors, these three big areas of the economy, was running about 3.2%, right? Even in 2018, 2019, it was about 22.7%. Last quarter, it was 2.3%. Remember, headline was negative 0.3, but final demand is 2.3%.
Right.
Then you take out government, and it was 3%. which is very close to what we saw last 2 years. But here's the thing, that includes all the stuff we imported. So that's where things get messy. It's like, wait a minute, business investment went up, or, business investment in IT equipment went up like 22.5%.
Right.
So that is included in that final demand number, but we know that's imports, right? So it shouldn't technically count. Let's say it's very messy. And I think the next two numbers are going to be messy too. I think Q2 is going to be messy. Q3 is going to be messy. Remember, we have the pause, which gives companies even more opportunity to front run tariffs, right? At least for 90 days. So we're going to see, this is going to be a mess going forward for the next 2 years.
I see why your nephew's crying after what you just said. That's, no, I mean, listen, so I'll just chime in. I mean, so the reality though is the consumer is okay. I mean, I guess, like, the consumer is 2/3 of the economy. You just talked about a bunch of stuff. The number is a number. I said this number, and honestly, the next number we're going to talk about, the monthly jobs number, it's something for everybody. If you want it to be bearish, you can make it bearish. If you want it to be bold, the White House was out there talking about, you said 22.5% growth in business equipment, and I can't even remember writing something investment. But saying no recession because of that. You're saying, well, yeah, because they're doing it because of your policies. They're buying it early because of your own policies. Is why they're doing it. But how's that consumer when you break all that down?
Look, on the surface, again, like, household consumption rose just 1.8% in first quarter. Slowest pace since, in about 2 years or so. Okay. But a big reason for that was a pullback in auto sales. And we knew that. You and I have talked about that. January, February, the weather was bad. And we got lower auto sales. We did see a big recovery in March. Again, there was some front running of tariffs there, but not enough to completely offset what happened in January and February. And what, I think that was a big drag for household consumption. If you look at services spending, right? Services spending is usually solid. That was up 2.4%.
Well, we got ISM services this morning, came in better than expected too.
That's
real time. We just saw that one. Services hanging in there.
Yeah, services are hanging in there. And it's not like a leading indicator or anything like that. We'll talk about payrolls, and what could be a leading indicator for the economy. But services, the economy was slowing in Q1. Because in 2023, 2024, services spending was 2.9%. There's a reason we got 3%, close to 3% GDP growth, right? It wasn't just all government and things like that. Services spending was really strong. That slowed to 2.4%, right? Okay. So if you stay there, that's pretty good. Now the question is, are we on a downtrend?
If you stay
that's
there.
That's the thing. I think that's my thing with consumption. And then, leading that into what we saw with the payroll report, look, where does consumption come from? Incomes. Where does income come from? Jobs and salary growth.
So we'll go to the income or the jobs number in a second. So anything else from GDP you want to touch on? I think we've covered it.
I think we're going to be struggling with GDP reports for the next 2 quarters as well.
Understood. So I'll just say this much. I took a look again. You're not an economist, but you play one on TV, and I sometimes play one. By no means do I understand it all, but I do know this much. The last 10 years, I was like, man, it feels like the first quarter's usually been weak. So I just went into Fred, St. Louis, Fed, and quickly did a quick little Excel thing. First quarter of the last 10 years, by far and away, has been the worst quarter for growth. And then you get more growth as the year goes on. So, we talked before, sometimes you get bad weather early in the year. Yeah. It reminds me of the old joke, why did God create economists? To make weathermen look good. Is it somewhat as simple? I know it's never that simple. I get it. But we had bad weather early in the first quarter. First quarter has been weak. Is that why the first quarter is weak and later in the year is better, or is there something else going on there?
I think it gets to that. We've seen that in inflation data. Suddenly, inflation data in Q1 always looks very high. And like, wait a minute. Yep. So I think there are seasonality adjustment issues. Yep. Right? That's one thing nice about economic data. Like, earnings are not seasonally adjusted. So you have to do a lot of things like do year over year or something like that. The nice thing with, payroll growth or any of the economic data that we get, it's all seasonally adjustment, but that's not an exact science, right? Seasonal adjustment, especially after COVID, I think it threw a lot of things off. And that's why we're getting this weird thing where Q1 looks softer, but inflation looks higher. And part of it is also because inflation looks higher in Q1, when inflation adjusts nominal growth, you're taking a bigger chunk off, right, to get to real growth. And that's probably part of it too. And I think, you can't just take one number and there's no smoking gun indicator. I hate looking at, look at GDP. First of all, it's delayed, right? GDP doesn't tell you, anything of, I mean, it's useful. We want to know what it is. But for our business, in terms of following markets and market bottoms, market tops, things like that, GDP is not what you want to look at. It comes out 30 days at the end of the quarter,
Right.
and then it's revised. It's going to be revised heavily going forward. It's revised even 2 years from now.
Right. I think where this matters, because we have a lot of financial advisors, obviously, that listen to us on this podcast, and a lot of clients listen to stuff. It's all over the place. Well, first quarter GDP was the worst. It is because of this. It's because of that. So that's why it's really important, I think, to talk about. But I'm with you. It is a lagging, to a degree, indicator. I will say this much. Earnings, the M&M boys, Microsoft and Meta had really strong earnings last week. CapEx is strong with Microsoft, and Meta had some positive things to say. I'm sorry, the cloud. The cloud was really soaring. Get it? Cloud soaring? I don't know. That was a stupid joke. But anyway, cloud was really good. And Meta's one with a strong CapEx. All I know is Microsoft last week is up 11%, Meta's up 9%. That matters. But the other M, there's a third M, MasterCard. MasterCard came out and said, listen, we're not so sure what everybody's talking about with this consumer. Consumer looks pretty good to us. That's the guts of what they said. Now, I get it. They're a credit card company. They probably want a strong consumer, but they'll also probably be honest. It's like talking to the small cap value manager. Take a wild guess while he buys you dinner at the steakhouse, what he's about to sell you on. It's small cap value. But, I thought that MasterCard, what they had to say, didn't quite get the pub, if you will, of Microsoft and Meta. That was impressive, I thought, from a consumer point of view. Anything else on one more thing on GDP. One more thing, Sonu, then we'll wrap it up with jobs. So we might have 2 straight quarters of negative GDP. What they still tell us, possible, tell me there's a chance, right? Lloyd Christmas, tell me there's a chance. That's a recession, right? And I know the answer. You know the answer, but our clients hear this. I mean, clients, listen, when we were back in school, well, you're older than me, so I'm not sure when you were in school. You're a lot older than me. But, a couple decades ago, they did tell you 2 straight quarters of negative GDP was a recession. People still live by that. Talk to me about why it's really not, even if we have a negative second quarter.
Now, if you think back to 3 years ago, 2022, Q1 and Q2, 2 consecutive quarters of negative GDP growth. First of all, even at that time, we were talking about the fact that we didn't go through a recession then, right? By the way, I think Q2 of 2022, negative GDP growth was revised to positive. Yeah. Two years later.
I just learned that this morning. We mentioned that on a call this morning. I said, we didn't have 2 in 22? I know this for a living. Call me old-fashioned.
We didn't have 2. Yeah. So there's a reason why you shouldn't go by that. Because, first of all, it's not even real time. But even if it's like 30 days, 60 days after a quarter, you really don't know. It could be, especially negative 0.3%. It's very close to 0. It could very well be adjusted positive. I have a feeling it's going to be adjusted positive. If not in the next 60 days, 2 years from now. Right. So that's not
just give it time.
Just give it time, right? But Q2 could be negative. But let's say so this is going to come up, right? If 2 quarters consecutive negative growth GDP numbers. No, it's not a recession. This is because the data can be revised. All of that. In the US, we have something called the Recession Dating Committee from the NBER, which is the National Bureau of Economic Research. And it's up to them to declare when it's a recession, when the recession starts, when the recession ends. They never do it in real time. They usually do it way, way, way after. But they look at a different set of indicators. They look at 6 indicators.
Josh, mark this time down. We're going to put this up right now, the 6 indicators for the NBER. Sonu will get it to you. Put this up right now on YouTube. Go ahead.
Right. 2 of the indicators come out of payroll surveys, which is the establishment survey, like how many jobs are being created every month. And then the household survey, too, how much a payroll is growing. That's where the unemployment rate data comes from. Then you got industrial production, retail and wholesale sales. So that's 4 indicators. And then personal consumption, personal income, real personal consumption, real personal income. So adjusted for inflation. These are the 6 indicators, sort of real time-ish. It's more timely than GDP. It's still lagging a little bit. But that's what the NBER uses to date recessions. And they do it well after the fact. 2008, I think it was the fall of 2008. They said, the recession started, like the recession started in December 2007.
The world was falling apart.
Right. Yeah. And then, if you remember, markets bottomed in March of 2009, 666. And by the time they declared the end of the recession, I think it was August or September of 2010. 2010, they said, the recession ended in June 2009. I was like, thank you very much. So anytime you pull up a chart, you mentioned Fred or any of the chart, like some of the charts I make, you see the gray shaded areas, right? We don't know those gray shaded areas happen only well after the fact, after the NBER is sure we had a recession.
Well, no, so we'll talk about that a lot. One more thing I wanted to point out, thank you for mentioning that, is, we talk long enough, we're going to remember everything I wanted to talk about. When there are some people out there on social media that say 9-day win streaks on the S&P 500 only take place in recessions, or somehow they got the data of like 80% of the time it happens in a recession. Well, that's not true. That's simply not true. I looked at the actual data without having a bias before I went into what I wanted to talk about. So there's 29 times we had a 9-day win streak, going back a long, long time. Only 3 of those times did the 9-day win streak happen in a definition of a recession according to NBER. You have to go to 1970, the last time we had a 9-day win streak taking place in the middle of a recession. It's simply not true. It's simply fake news. It's simply something you should avoid. I mean, it drives me crazy when people just make up numbers and thousands of people share it on social media, getting all bared up, said, oh my goodness, this 9-day win streak is a terrible thing because it means we're in a recession. No. The data, which takes like 5 minutes to actually compile this, says that's not the case. I just wanted to kind of get that off my chest because it really frustrates me that that stuff it's happening. It's happening. But hopefully on this podcast, we're not always going to be right, not always going to be wrong. We're going to be honest, going to be upfront, going to try to explain what we see the best we can. And so let's try to wrap this up in 5 minutes on the jobs data. A lot of worry about the jobs data on Friday. Came into 177,000 jobs created, but I think the previous 2 months had like 59,000. So if you take that out, it kind of came in about what was expected. But the reality is market seemed to like it. Market rallied initially. It's not as bad as we were fearing about a month ago. Talk to me a little bit about the labor market.
It's, again, we were talking about surprises, right? And in this case, it was good news. Good news is taken as good news. The labor market hasn't cracked. I think that's a big takeaway from the April payroll report, right? And I think there was an expectation, which shouldn't have been the expectation, to be honest, that, because of Liberation Day, April's just going to crash. We're going to get a really bad payroll report. But look, for one thing, the tariff shock, well, some of them were pulled back. A lot of them were pulled back. We still have 145% tariffs on China and whatnot. But still, it's not like the economy is going to crash off, the side of a cliff, immediately within a month or two even. It's probably more of a slow burn problem, right? But then I think there was this expectation, things are going to crash. And the other thing is the payroll report data was collected second week of April, before any of the impact from the more extreme tariffs on China. So there is that piece of it too. We may get a little more weakness. Maybe it's in areas like transportation and logistics, which actually saw like 29,000 jobs created in that area, transportation, warehousing, things like that. And I think that was a function of tariff front run, right? The question of what happens in May. But in terms of a broad-based decline, we didn't see it, right? The average number of jobs created, including revisions, this is why you want to take like the 3-month average, was 155,000. I think that right now, that's more than enough to keep up with population growth, especially because immigration's lower. And that's also why the unemployment rate is unchanged at 4.2%. 4.2% is a historically low unemployment rate. And the other side of it is now where things are, I don't think it's all rosy, is that most of the job growth is coming in.
I see what you did there, by the way. I see what you did there. That's a joke for us. And maybe someone else who knows what I just talked about with 9 days. We'll leave it there. We'll leave it there.
We'll leave it. We won't mention names. But kind of did. But
it's kind of rosy out there. Continue.
So job growth, most of it is coming from non-cyclical areas, right? Healthcare, social assistance, private education, government created about 80,000 of the jobs in April, about 45%. And that continues the theme of what we've seen for the last 6 to 12 months. It's been non-cyclical areas of the economy that's driving job growth, whereas we are not seeing a lot of job growth in the cyclical areas of the economy, whether it's professional business services, manufacturing, especially. Construction sort of hanging in there, but a lot of that is coming from civil engineering construction, that's state and local governments, right? And then non-residential specialty trade contractors, that's also in construction. That's manufacturing facilities. You remember that big chart of manufacturing facilities construction. Now they're putting in all the wiring and HVACs in those factories, things like that.
Right.
That's where, you still have that downstream impact of, we built a lot of factories. Now we have to make sure it's, we can put equipment in, right? So that's what's happening. But I think the big takeaway, like I said, from the payroll report is the job market hasn't cracked. But because of that, the other side of it, the Fed's going to stick around on pause for long. a May rate cut. The Fed, we'll talk about it next week with the Fed rate meeting. They're not going to cut rates in May. I think June may be off the table too.
Okay.
So I think we were talking about what could surprise the market. I think the market's expecting rate cuts. We may not get rate cuts maybe until September now.
Wow. Well, that'd be a surprise. Honestly, market probably wouldn't like that. I guess we'll kind of wait and see. But yeah, this week is the Fed. Maybe by the time people listen to this, the Fed decision's already happened. Our base case is there's not going to be anything from the Fed. They're setting the stage for something. I guess we'll have to see. I am excited for the Q&A when they ask Jerome Powell, "Hey, your boss doesn't seem to be a big fan of you. What do you think?" And he always plays down the middle. But I don't know. We'll see.
We were joking that this week is fairly quiet. You and I don't travel. We don't have a lot of data coming. It's a Fed meeting, of course. But I think we're going to get some fireworks from, some Twitter accounts on Wednesday night or Wednesday evening.
Oh boy. Yeah, that's a good chance. That's we can't make guarantees. We live in a world of no guarantees, but that is about close to a guarantee. If there's no cut, there might be a tweet or two potentially coming. So anyway, all right. Well, we've kind of hit the end of the road. Thanks to all the listeners. We really appreciate it. We've hit some really good numbers the last several months, especially on the YouTube channel. So thank you. Thanks to Josh, our producer, for making sure we do this correctly. We would just still we'd be talking for 2 hours. We have to shut up. We can go all day on this stuff. But well, Sonu, safe travels to you. I'm going to have some fun down in the great state of Texas. And with all that, everyone,
you get a bathroom to yourself.
I get a bathroom. Yeah, I get my own shower without having to take a shower. And my daughter's in there. It's like, what are you doing here? Like, you should be in school. Like, why are you here right now? She always has some reason. It's like 10 o'clock. Like, I don't even ask. I got a 17-year-old daughter. I don't even ask. She's home. Whatever. I'm not in charge. I just come to the basement. Got my big fat Great Pyrenees sleeping right there. He and I just work down here all day, and I just do my thing and try not to get in trouble. So, and go change a diaper, Sonu. Go. That was the rule, right? You told your sister you can save for 3 months. I'm not changing one diaper. That's the rule. All right, everybody. This is Facts versus Feelings. See you next week. Thank you. Take care.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.